I'm Scott Kelly, and you're watching Influencing Entrepreneurs with Cassmer Ward.
After years of teaching entrepreneurship and consulting business owners, I realized that true knowledge comes from the wins and losses of those entrepreneurs. These are the stories of those business leaders. I'm Cassmer Ward, and this is Influencing Entrepreneurs. Well, today we're here with Scott Kelly with Black Dog Venture Partners, and I really appreciate being here today, Scott.
Thanks for having me, Cass. Appreciate it.
What I'd really like to talk about, just kind of starting right off the bat, is I know you're on to bigger, better things, but I really want to talk about where your entrepreneurial journey began.
Well, it's been an entrepreneur probably since the age of 11. I started a couple of my own businesses, selling trading cards and newspapers, and was pretty much entrepreneurial most of my young life. I started out as a retail stockbroker. I went from New York to Lafayette, Louisiana. And I had to learn very quickly how to sell, how to work hard, how to not judge a book by its cover. And I had a pretty successful career doing that. Moved to California, worked as an investment banker for a few years, taking technology companies public. And then in '93, the real entrepreneur bug hit me. It was during the dot-com boom. I set up my first internet company. I had that and two other companies that I launched and exited between '93 and 2000. And that really kind of
accelerated. What type of businesses were those? Because that's at the precipice of all of it.
It was, we were involved in a number of smaller companies, but they were in some of the technology you take for granted now. We were investors in music technology, and we had a very good run there. We had the first online mortgage company that originated mortgages online, and they were acquired by Wells Fargo. And so we were involved in a lot of interesting things. It was an interesting time back then. There's probably some similarities to the AI, times today, is that you effectively back then you could put .com on a light bulb and make money. And, we did. So we had some pretty good runs in both entertainment, consumer products, and in the financial fintech space.
Let's do this because you brought up a really good point of how that tech bubble, the internet bubble back in the 90s as where we are in AI. And let's try, maybe me and you can connect the dots. Maybe we can make us some money while we do this in the AI market while we're going along. Right now, it's so intuitive. I'm going to build an app. I'm going to build a platform and all that. But to be honest, back then, only the elite few that were in that space knew what the words platform, app, website. I think the more interesting piece would be the entertainment and music part you were mentioning. But let's start with the boring part, mortgages. And not service mortgages, or what was the actual?
It was not only the internet, but it was an interesting time from the economy standpoint. We launched the first online wholesale mortgage bank. And basically what that meant was we would buy a portfolio of mortgages and then resell them to institutional investors. And before the internet, it was just making a lot of phone calls and spending a lot of time doing it. And so basically we were able to use the internet to pull in all those mortgages, package them, and then immediately put that opportunity in front of somebody that they could look on their computer screen and make an offer to purchase it. So, that was a way to really streamline the process. And honestly, back then also, there was a wide spread in interest rates. We were doing what was traditionally non-commercial grade mortgages. They were typically called B or C paper. Back then, there were 200-300 basis points margin there. So there was a lot of margin to be made. So we were able to, take a margin and the ability to accumulate, package, and resell these mortgages very effectively, using the internet.
And forgive me for sounding ignorant, but part of that was early on, you could run a company like that, not make a profit, and still exit exponentially. Were you at a point where you were profitable?
We were close to profitability. You make an interesting point. There's a lot of cases where sometimes a company will be acquired because they're profitable, and sometimes they have a technology that someone else wants to use to become profitable. And that was really the case with us. We were at the point we could grow as large as we could with the team that we had. But a large institution had the ability to grow it, far, far larger than us. So that they saw that as an opportunity.
So I think you said it was Wells Fargo.
Yes.
They could literally just feed their current business line into that platform and multiply it 100-fold, if not 1,000.
Right.
At that point, if you don't mind me asking, how big of a business were you able to build around that on a revenue basis?
And again, this is over a very short period of time, probably less than 2 years. We were generating $40-50 million a year.
Okay. That's excellent. Yeah. And still with that industry to even just be at break even, I mean, it's a grind.
Right.
So how about the music and entertainment platforms you played in?
When I was an investment banker, we helped MP3 raise a bunch of capital. Most people don't remember that, but that's the Spotify of the 90s. They more or less originated streaming and digitizing music. And so we had a pretty successful run there. I still kind of stayed in around the music business for a while. It was a fun industry. Towards the end of the 90s, I had the opportunity to invest in a record label, knowing nothing about the music business, and by some ridiculous stroke of luck, our artists won a contest on MTV. The next thing I know, we are selling hundreds of thousands of units, and we're on the Billboard charts. And so I spent a few years in the music business there too. So
I gotta ask, can you share what artist? Anybody we
it was
heard of?
it was a hip hop artist. He's not really well known anymore, but we had a very famous producer called KRS-One. He was the same producer that produced folks like Eminem and others. So we had the virtue of two things. One, back in 99 and 2000, MTV was still putting out music videos. So they produced our first two music videos. And then we obviously had this legendary producer produce the artist.
So I actually know KRS-One, not personally. I know the personality,
Right.
So excellent. So getting through all that, getting into the 2000s, where does that path take you next?
But what happened was after 2000, I thought I was going to retire. And I tell people that was my first unsuccessful retirement. I moved from California to Arizona, kind of dabbled in a few things for a while. I ran the music industry business for about 5 or 6 years. We were doing other things like music licensing, getting music into video games and television and shows and movies, and had a fun run with that. We winded down that business, sold off some of the parts to another record label, and then that's where I started Black Dawn Venture Partners. And what I learned throughout the 90s, I established a lot of relationships with some of the larger venture capital firms in California and around the country. And what was happening is that after the internet bubble, there was a lot of companies that were too early or were being turned down by these larger venture capital firms. And so they began to say, look, Scott, these companies have interest and potential. Maybe you could shepherd them and get them ready for us. And that's effectively what we do. We've been working with these early stage technology companies to help them build their team, get ready to raise capital, put them in front of the right investors, help them scale their business, and then we either hand them off to those larger firms or let them go on to exit on their own. So,
can you give me maybe a avatar of like who might come to you and walk me through that process?
Sure. Yeah, a typical entrepreneur will come to me that is probably has some good technology, and they probably have a product they can sell, but they haven't gone out and sell yet. We work with a lot of technical founders that are good developers or good technologists, but maybe they're not very good at go-to-market or good at sales and marketing or don't have those other pieces. So what I have found is that investors love technology, but they love founders that can execute and generate revenue more. And so a lot of cases, these companies will come to me and say, look, we can put you in front of investors. I got 13,000 investors I've done a transaction with over the last 30 years. So I have those relationships, but you don't want to go to those relationships until you're ready. And by ready means you need to make sure that your pitch is correct. You have your deal room ready, but you need to make sure you have some traction and you're moving forward. And so a lot of cases, we help them. I tell people all the time, we want to paint the car while we're driving it. What I mean by that is obviously while you're trying to get in front of investors, raise capital, you want to continue to build the business. And that's what we help these entrepreneurs do.
Yeah. So do you have a talent pool that you're able to pick from?
Yes.
Does your team go into there and just
We have
play a role?
we have people internally, and then on an as-need basis, we have a whole network of folks that we've worked with over the last couple decades.
On those early stage tech firms, what is the thing they are missing the most right off the bat?
It really depends. Different companies have different needs, and I think a lot of cases entrepreneurs think they need to raise capital, and they think raising venture capital is the solution to all their problems. It might be a solution to one problem, but it could be a problem in and of itself. And so I really sit down with companies and say, look, what is the real goal? Which we have a very simple thesis. It's to solve problems and create opportunities. And solving those problems might be raising capital. Some of those solutions might be selling your product or service. And then obviously the opportunities are preparing them to put them in front of investors or preparing them to putting them in front of potential customers and partners. So we really look at each individual company on a one-on-one basis.
Okay. I kind of want to talk about the two different aspects of that, having played in both worlds there. To you, this is second road at this point. But like, how do you find those investors? How does someone go out and literally, finding money actually sometimes is a lot easier. It is a lot easier than finding the right investor, because there can be the bad investor with more money that you should stay away from.
Absolutely. Well, yeah, it's interesting. I think it's a process. And I tell entrepreneurs all the time that raising capital is a full-time job and running your business successfully is a full-time job. And the extent that you do one, the other could, or both could suffer. And so I think the reality is that it's like anything. It's sales. At the end of the day, you have to build a funnel of people, establish relationships with them, qualify them, present the proper opportunity to them, and then depending on what you get of yes, no, or not yet, keep them up to date and keep the communication going. I think of a lot of the same tools used in selling anything else are used in raising capital.
Okay. So in doing that piece, what are those investors looking for within the pitch, within the in the business, within the technology even? Are they looking at one versus the other?
I can speak of myself. I mean, I have stakes in a number of companies myself that I've invested in through angel groups, VC funds I'm a member of, and others. At the early stage, obviously, technology is important, but it really comes down to really a few things. You got to have a problem that's worth solving, and it's a big enough problem for enough people. You got to have a better solution. And why is it better? Is it cheaper? Is it faster? But especially when it gets to early stage companies, it's really about having a team that can execute, because a lot of times there'll be a solopreneur that'll want to build an idea, and they may be able to build a good idea, but it's rare for a solopreneur to be able to build a successful company around that idea. So especially at the early stage, team is probably one of the most important things, especially at the early stage, that myself and other investors look at. And then obviously there's other things like your competitive analysis, why you're better than others, your go-to-market, your sales structure, how you're going to make money. Those are all important categories, but it really comes down to having a real problem with a real solution and a team that can execute.
So one of the things I would bring up at this, that it is a challenge, is coming in at the stages we're talking about. I'm assuming a lot of these are pre-revenue.
A lot of them are, and you're really at the highest risk profile for an investor. You have to understand something, for large venture capital firms, that if they can bet, like baseball, if they can bat 300, they're in the Hall of Fame. They're working on the rationale that the vast majority of the companies are going to fail. The statistics lie out. 90% of startups fail in 2 years, and 75% of companies that raise venture capital fail. So entrepreneurs have to look at it from the other side. They really have to understand, when they communicate with an investor, okay, my job as an entrepreneur, in your case, Mr. Investor or Mrs. Investor, is to, one, get a return on your capital, but also get a return of your capital. And those are things that are the things that investors really need to and want to hear at the end of the day.
I know it varies. But let's talk about a pre-revenue company. What is the range you see that usually that first seed round goes for?
Well, that depends on a lot of things. One, it depends on the industry. It depends on the timing, where we are. I believe last year, the average seed round was somewhere around $6 or $7 million as a valuation of a company. But there's a wide range of that. You will have a health tech company or a medical tech company might have one valuation, or an AI company could have a ridiculous valuation like we're seeing in the news now. So I think there's a wide range, but and honestly, pricing a company is art, not science. You can get all kinds of second-party valuations. You can validate yourself against anybody else. But it's really, I tell entrepreneurs all the time, the value of your company is almost 100% based on what an investor is going to invest in that.
That would be my next question, is that art part is, I have this idea, we're going to go to, you're helping me, point me in the direction to raise my first 5 million. Let's just say that.
Right.
Of that 5 million on pre-revenue, does that mean you're getting 50% of the company, 9%, 90% of the company? 10%?
Again, that's a wide range. There was, today in the news, based on when this is going to be released, there was a company that's raised money at a $50 billion valuation that has minimal revenue. But then you have a brand new startup that can't raise money at a $5 million valuation. Again, that's where it comes down to those things I mentioned before. You need to have a good team. You need to have good resumes. It's always good to have people on your team that have had a successful company, maybe have raised capital successfully, had a successful exit, in order to give the investor that comfort level to pay what you want. Because it's really a song and dance. You've got, this is what investor you wanted your valuation to be. This is where the investor is. It's that negotiation to find a midpoint that's palatable to everybody involved.
Right. Well, at that point, everybody's looking for investors in some form.
Right.
So let's talk about like what investors are looking from, because you mentioned a lot of the sourcing that your experience has provided to companies and to entrepreneurs, because you do have the entrepreneur that just has a great idea, doesn't know how to do anything. And sometimes you have the entrepreneur that knows how to do something really well and can do it, but the idea is maybe mundane. Are investors looking for, like, is it easier to find an idea in a highly sought after area where you can plug in people to make that idea come to life? Or are they looking for that person that they know they're going to work their butt off?
Yeah, you make a good point, because the reality is it's got to be both, because there are all kinds of stories about companies that raised a lot of money with successful people on really bad ideas. They had those results. I taught entrepreneurship during COVID at a university in Phoenix, and I told them the story of a company called Juicero. They raised $120 million from the top venture capital firms in the country, and their technology was to build a juicer using an app that could make juice in 3 minutes, and the cost of the juicer was $2,400. They put out a video showing this, and you can probably tell what happened. Someone put out their own YouTube video showing how they made juice in 30 seconds with their $100 blender. Long story short, that company, after raising $120 million, lost all of it, went bankrupt in under 24 months. So it's got to be a good story as well as good people that can execute.
Well, that goes to what you mentioned talking about earlier, which is identifying what your sustainable competitive advantage is. Because
Exactly.
if it's like, yeah, we can make juice faster,
Right.
which I don't know how that wasn't even caught in the initial pitch, but so be it.
Well, some people are really good. You find people that are really good at running companies, and finding somebody really good at pitching investors. They don't necessarily always get together in the same room.
Yeah. Well, and sometimes it's not even just that. People are buying the idea and the concept of how they're going to sell it.
Right.
Because I'll be honest, you could have marketed the same thing like, ours is so good, it's going to take a minute longer because of our proven process. Like,
Sure.
you find a million different ways to.
Right.
You could even say the 30-second juice is killing you because it's not releasing the antioxidant.
Yeah. Obviously, I mean, I told you the thumbnail version of the story, but obviously you got to do a lot of things wrong to lose that much money that quickly.
Yeah, I know. And I'm sure there's a whole lot more behind it. We'll wait for the Netflix documentary on that one. So as you continue to do that, how does your path evolve? Like, where do you keep continuing to go from the 2000s to today?
Well, I ran the business, and honestly, I just love working with startups. So I've been fortunate to work with some great companies over the years, and have a lot of them become successful and growing and raising capital and exiting. And then the reality is that we've built this large network of investors that will send. We exchange deal flow all the time. If there's something is not good for me, I send it to them, and if something that's good for them, they send it to me. So I've been able to continue to build that business over the years. I moved to Florida 3 years ago, and I tell people that was my second unsuccessful retirement. I came here, thought I was going to retire, and I decided I was a terrible golfer. I couldn't fish every day, so I just kept doing what I love. And now I'm in Florida, where I think there's great opportunities. And it's not San Francisco, it's not LA or New York. It's a different market. And that reinvigorated my interest to keep doing what I'm doing.
So I do want to circle back to a term you've used a couple times, just like for my students, deal flow. Even in industry, I hear this term thrown around all over the place, where deal flow could literally mean how many coffee meetings you're going to have. How would you define a deal? And then let's talk about the deal flow as a collection.
Well, I mean, the deal itself, I mean, there are, as of last year, there were close to 3,200 venture capital firms in the US, and then literally tens of thousands of angel investors and angel groups and millions of accredited investors around the country. So the idea is that I've been able to build a good network of folks that I have good relationships with. The investors is a relationship business. You know, the investors will invest with other investors that have done the due diligence already. They will share that
But to
deal
get to
flow.
that point, Scott, and this is one thing I just want to understand better. Let's say I want to be one of those deals in that deal flow. Do I constitute as a deal? You've identified that I've got an idea that I want to fund, or that I am already under some sort of due diligence. Like, when does it cross over to be a deal to be in the flow?
Well, I think you know, again, the due diligence is a piece of the process. Is obviously not the beginning of the process. So typically, what happens is entrepreneur will have an idea. They will put together a pitch deck, which is really kind of a short summary of an investment opportunity for an investor to look at. They'll build their team, and then they'll put together what's called their deal room, where putting all the due diligence materials, all the things that an investor needs to make a decision, like financials, projections, resumes of the team, intellectual property, and other things. And then once a deal, that is effectively a deal. And then,
So literally, if I show up at your house tomorrow and I gave you a pitch for the 15-second juicer,
right,
and I told you I was looking for money, I am now a deal in the flow. And you learned your lesson. You're not going to go down that route,
right.
but you might point me in the right direction
Well,
of
yeah,
someone else's.
yeah. And what I typically the process, I mean, we'll vet them, obviously, because you know, there's a million ideas floating every single day.
Right.
We like to have the idea that's somewhat vetted. They've done some market research. They've got a few people around them that are committed to helping them with the idea. It's got to be a little bit farther down the line. At that point, we will work with this company to help them put together their pitch deck, make sure their presentation is correct. We host pitch events where they get an opportunity to present their company to a group of investors. We've been running VC Fast Pitch as an event for about 13 years, and we do those every month online, and we do 5 or 6 in-person pitch events around the country. So we use that as a vetting process to see if they are good enough to go to the masses, or so to speak, or go to a larger network of potential investors. And then it becomes deal flow. I will share that opportunity with investors I work with, and then somewhere else, some other side of the country, they've gone through that process, and I will have that deal go in my inbox.
Okay. So on any stage of that, do you have like, and I don't want to pry too much, do you have a cap, or do you have a, like, what you want your deal flow to look like? Are you normally looking at 100 deals at a time, 1,000?
Well, I get literally probably 100 pitch decks in my inbox every month.
Okay.
I get a lot. We have mostly I'm taking deal flow from trusted investors I've worked with before, because I know they've done some level of due diligence on it. I will typically get referrals from other entrepreneurs that I've had some good luck with, but that's really where it starts. Every investor has their own vetting process and their own way to access deal flow. Our pitch events are a good way to look at that. I've had companies pitch at our events, and then an investor says they're interested, and then it becomes a deal. It becomes an opportunity.
On all of that, Scott, has there ever been a deal that you've worked on that you were like, this has got a snowball's chance in hell of actually working out, that took off?
Yes, I have, and I've had the opposite. It's
Do you
really
mind sharing?
Well, I'm trying to consider the best opportunity. You know, I had it's really interesting. I had a company pitch at we had hosted a pitch event in Phoenix, and the 2 entrepreneurs, they pitched a company called Crowd Mics, and basically was using your phone as your microphone at a conference. I go, that's not really good technology. It didn't really excite me personally. They pitched at my event in Phoenix. They spoke to a gentleman who runs an angel group called Sand Hill Angels. They had lunch during the event I hosted. A few weeks later, they flew up to Menlo Park, and the gentleman invested in the deal. He was their very first investor. A few years later, they raised $3 million. A few years after that, they actually sold the company for a significant exit. Now they're a venture capital firm that has invested in 300 companies themselves. So
Yeah.
I thought, okay, a phone has a microphone. That's not like rocket science, but they built a nice business. They exited, and now they're the people on the other side.
How about the one that you thought was going to be a rainmaker and it just didn't get there?
Wow. I think there were a couple in the, during COVID, the whole crypto space was very hot. And we really thought the tokenization of music and coins for the music industry was going to be a great way for artists to make money. Then the COVID stopped and people started going back to concerts and it just didn't work. So,
Oh, so no, and it is one of those things that it seems like it's kind of a constrained environment that you don't know, will this last a year or 20
right.
years?
Well, sometimes ideas just come too early
Yeah.
or the technology doesn't catch up with it. I remember in the late 90s, anybody listening who's my age will remember a company like pets.com. They raised literally tens, if not hundreds of millions of dollars and went out of business. And only thing left was the sock puppet from the commercial. But today you got Chewy and other providers that are doing it in spades.
Yep.
So the technology was not ready for the industry. In some cases, that's how the reason why they fail. They're too early.
Yeah. So doing all this, you've also recently launched the Emerging Managers podcast.
Mm-hmm.
What made you say I need to go down the route of podcasting as we're here on this podcast?
Yeah. Ironically enough, I had a small stake in a podcasting company, and my partner, she kept asking me, Scott, you should do a podcast. I'm like, well, I don't want to do a podcast. I don't have the time, and I'm not sure what I would do any differently. And then it was much like, I tell startups, I saw a problem. And the problem was there was an article towards the end of last year that out of the 3,200 venture capital funds in the U.S., I think it was 78% of the money that went into the funds went into the top 25 to 30 funds. And so I saw there was a gap. There were these earlier stage venture capital funds or newer funds, startup funds, for lack of a better term, that could not get the exposure and the investor buy-in. And so we decided to say, okay, let's try to level the playing field, because other thing I found was that these earlier stage, smaller venture capital funds got better returns than the monoliths because they are more hands-on, they are more conscious about the capital, and so we launched the podcast. We've done our 50th episode. We've really featured some of the lesser known managers, and we've been really helpful in getting them some awareness, and a number of them have brought on new LPs as a result of being on the podcast.
What have you enjoyed about doing the podcast?
I like having these kind of conversations. I like talking to people that are doing things, that are growing things, that are building things. You obviously have built a great business. You've got a great podcast. I want to be in those rooms. And if I can be in those rooms from my office, or today my home office, why not? And I really like, and what it does, it keeps me on the cutting edge. I'm talking to these investors who are doing some amazing things. We talked to an investor that is investing in companies that are developing drugs in space, which I was amazed by. Everyone was talking about AI and data centers. We interviewed an investor at the beginning of the podcast who was developing all the energy for the impending energy need. So that's the fascinating part. Is obviously that you've probably learned is you meet some interesting people, you get some good ideas, and you build some relationships. And that's really that's been the best part of doing the podcast.
No, and not only that, what seems to be happening with the podcast is, of course, we all want our podcast to be the one that's making $1 million a month in ad revenue, but it really is almost taking the place of phone calls. Like we're starting, what do they say? Something like only 1% of all podcasts truly get listened to. So I'm like, I'm glad I'm proudly in the other 99%. But like we've built a small audience, but it's weird how our guests have connected with one another, how the small audience we've had. And when I say small, as opposed to those that are listening to, the bigger one. Scott, if you and I started talking about murder, the ratings would go through the roof.
Sure.
That's what it takes to be a big podcast. But a lot of the people within these networks, they're joining into those niches, and it's becoming, not just content for content's sake,
Right.
but more content that people can gravitate. and create their unique experience.
It's been really satisfying from a couple of standpoints. I was having a follow-up call with one of the investors on my podcast, and I told them how people were using the podcast to introduce themselves to potential new investors in their fund. And he goes, well, I'm doing just the opposite. I go, what do you mean? He goes, well, if an entrepreneur comes to me and they want to learn more about my firm, I send them the link to our interview. I was like blown away by that. I was very pleased by that. And the interesting thing, it's become kind of its own thing. We are in the process now of taking our first 50 episodes and turning them into the Venture Investor's Guide to Emerging Managers. We're going to publish our first book based on the podcast.
Excellent.
And we've got investors that want us to moderate panels for them and we're going to moderate panels on emerging managers at different cities around the country next year. So what started out as a small little podcast, although we're not getting rich on the podcast, we're doing quite well because of the podcast.
Exactly. No, and you got to kind of measure it that way. So,
Right.
Scott, I think our days of being the podcast heartthrobs has passed us by, but we'll make it service accordingly.
Exactly. I tell people I have a face for radio, so good thing you can listen to this on Apple and Spotify. So
Exactly. So as we kind of are wrapping things up, here's the big question. What do you have planned for your fourth retirement?
wow, that's a really good question. I really just love what I'm doing. I guess at some point, the AI and the bots and the robots will probably replace me. But until then, I'm going to stay on the cutting edge. I'm traveling a bit more now. I'm getting back on the speaker circuit, which I'm excited about. I have a few other of my own side businesses, which I'm developing. I don't know if the third or fourth retirement is going to be any time before my final breath.
Okay. So excellent. And I'll be honest, it's hard when you got that entrepreneurial spirit in you, and more importantly, continue to be surrounded by entrepreneurs,
Right.
that it's hard to ever see that flame.
Yeah,
Dying
exactly.
So excellent. Well, Scott, I really appreciate our conversation today. There's so much to talk about, how people go out there looking for money, what those next steps are, and really the way you're able to connect what entrepreneurs are looking for versus where investors are looking, finding that connection between the two of us. So I'm really, really grateful for your time today.
Thanks for having me. I appreciate it.
No problem. Thank you. Thanks for watching. To watch more episodes of Influencing Entrepreneurs, be sure to subscribe on YouTube at Nexagy Education.